Good evening, friends. To introduce myself, I am Pallavarajan, representing PMS Bazaar. I welcome you all for another insightful session organized by PMS Bazaar. Thanks for taking your time and joining with us. So today we have Mr.Nishit Shah, who is a portfolio manager for PhillipCapital PMS, and he will take us through the presentation of the topic, optimal diversification with PhillipCapital multi-asset portfolio. To give a small introduction about Mr. Nishit, Mr. Nishit is a triple graduate with more than 13 years of experience in equity markets. He has been successful in identifying themes and stocks that have provided multiplier returns. He has worked with some of the most respected wealth management companies in India, including Motilal Oswal. Nishit, I welcome you and pleasure having you here with us. Over to you.
Okay, thanks a lot, Pallav. Thanks everyone for joining us. Yeah, I hope everyone is safe and healthy. Of course, thanks PMS Bazaar for giving us this opportunity to present this new strategy that we have developed. Okay, so now, of course, guys, let me take you through the presentation. Yeah, so the name of the investment approach is Phillip Multi-Asset Portfolio. Yeah, so of course it's actually a little bit self-explanatory kind of a thing that under this portfolio we would be using multiple assets classes rather than just only Indian equities. So these are the topics that we'll be taking you through today. So firstly, let me talk about PhillipCapital. I'm guessing that most of you would have not heard about us, or maybe they would have heard about us, but you guys would not know how big we are. So actually that way we are a very large MNC spread across 15 countries. Yeah, so we are right spread across from USA to Australia. We are headquartered out of Singapore. Yeah, and we have more than 45 years of existence. We are managing close to around $47 billion under asset and custody globally. Yeah, and that is what. So we are very strong in the Far East region. So you name Singapore, Hong Kong, Malaysia, Thailand. Yeah, Cambodia. We are a bank. Here in India also we are very large, but we are not present much on the retail side of the business, and that's why not many people have heard about us. We are present only across institutional clients. So you name a large FII, hedge funds, sovereign wealth funds, yeah, mutual fund houses, insurance companies. So these are our one set of clients, and the second set of clients are HNI. Yeah, again from HNI, from the largest of the HNIs to the all discrete HNI clients like you, they are our clients. So we focus mainly on this two set of clients. Of course, having said that, we serve only this two set of clients. This two set of clients are also very demanding in nature. And that is why we have got one of the largest research team. We have a research team of around 22 research analysts. Yeah, each one of our analysts would be more than 7 to 10 years of experience, highly rated in their particular industry and all those things. So that is what our backbone is. Of course, being an MNC, the technology, compliance, processes, it's a given kind of a thing. But actually, it's our research that sets us apart. Of course, nowadays, I know research is also kind of a very common thing. But I would say truly it is our research. And actually, we do a lot of ground level research. So it is not only coming out with company buy reports or sell reports, but we go at the ground level. My analysts would travel abroad, or maybe they will travel to the hinterlands of India to see what is happening. Yeah, maybe we'll also cover a small sector which is not listed, or maybe a company which is not listed, but just to give a flavor kind of to our investors, we provide that kind of a research kind of a thing. Yeah, so that is what about PhillipCapital is all about. Yeah, so now let's talk about the team. Yeah, the PMS team. Of course, we have got the senior management of PhillipCapital also part of the PMS team, Mr. Vineet Bhatnagar and Rajendra Phambani. Yeah, both of them have more than 25 years of experience individually in this markets. So they are also part of the team. Yeah. So what actually in PMS, it's now of course the minimum ticket size is 50 lakhs kind of a thing. Yeah. So it's a very serious business kind of thing. Yeah. And we take it as a personal kind of a responsibility when we are managing clients' money. Of course, when someone is investing 5,000, that is also a big amount, but of course this 50 lakhs is quite sizable. So we take it as a personal responsibility kind of thing, and that's why the senior management is also part of the investment committee. Now coming to the multi-asset kind of a landscape, yeah, why one should have investments across multi-asset. So actually, when actually we are working on this strategy since last almost 1.5 year kind of thing. The earlier plan was to launch this strategy on an AIF platform, but unfortunately, because of certain taxation rules, we could not launch it on the AIF platform. So now we have launched it under the PMS platform. So when we started looking at the data, we are very surprised. Yeah. And if you guys also look, see, maybe since April 2007 till June 2020, Nifty has given us a CAGR return of only 7.5%. Yeah, 7.76 to be precise. Gold has given us CAGR returns of 12%. S&P 500, which is a US market, that has given us around 9.5% returns. And fixed income, we have taken Bharat bonds, that has given us 9.5% kind of a returns. But you look at the volatility that the Nifty gets. Yeah, the drawdowns are close to 60%. The worst drawdown has been close to 60%. Volatility is 22%, which is the highest amongst all the asset classes. Yeah. If you see the 3 years average returns as well, then also the numbers are not looking that great, minimum or maximum, when you look at the average returns. So actually what has happened across last 10-50 years to generate returns in Indian equity market has been quite difficult, especially over last 4 to 5 years. And all of us would agree to me to that. Only few stocks have done well, and that is why the market is looking better. Yeah, but otherwise, if you look at broader markets, it has been not been that great. Yeah. So, and all the, see, you look at the drawdowns, the volatility across all the asset classes, the drawdowns and volatility have been quite high. Yeah, of course, in fixed income it can't be so much, but then if you see Nifty, gold, or S&P 500, it has been quite high. Of course, for all of us, equities, Indian equities provide us the best hope. And when I say there's a lot of volatility and drawdowns, it also provides us a lot of upside potential as well. Yeah. But how do you manage this volatility? So now in the next slide, yeah, actually this is one of my favorite slides in the entire presentation. Yeah. So again, if you look at the data, whenever Nifty has been negative, okay, for a 12-month period, okay. So what we have compared, when Nifty has been negative, what is the performance of all other asset classes during that period? Okay. So when Nifty was negative minus 15%, gold has been plus 24%, S&P 500 has been close to around plus 2%, Bharat bonds have been around 10.5% returns. So this is, so there's very low correlation between all of them. In fact, there's negative correlation kind of thing between Indian equities and gold kind of thing. Yeah. And if you go to say this particular data as well, yeah, over last 13 years, Nifty on a rolling 12-month basis has given a negative returns 25% of a time. Yeah, so that's a very big number, guys. Yeah, so out of 13 years, almost on an average 3 to 3.5 years, Nifty has given a 25% kind of a negative return. Yeah, but the saving grace has been that during those times, gold, international equity, and the fixed income has provided us the kind of a buffer kind of thing, and they have done better. Yeah, so diversification helps, especially on the downside. Yeah. So, of course, I apart from managing the multi-asset portfolio, I also manage Phillip Signature India portfolio and Phillip Emerging India portfolio, which is a pure fundamental driven long-term portfolios. Yeah. So, of course, those would tend to do little bit better than your normal markets because it is completely fundamental. It is stock specific and everything. But if someone is looking for passive investments or looking for normal managing their money on their own or something, so for them, I would strongly advise please diversify your portfolio. Otherwise, there would be so much bout of volatility and drawdowns. And this two words you will keep on hearing throughout the presentation because these are very important words for in the investment world. Not many people focus on it. Yeah. Let's take an example of in March only. Yeah. Till maybe January, February, everyone was gung-ho. Their portfolios were doing well. But suddenly in March, a big fall came in and your entire kind of returns were wiped off. So that's why diversification helps. Okay. So what we have done is let's take an example of a simple diversification. Okay. So wherein in this simple diversification, yeah, you are allocating 50% to Nifty 50, yeah, 20% to gold, 10% to S&P 500, and 20% to Bharat bonds. Okay. So if you look at this, yeah, the returns. So under multi-asset strategy, your returns, if you just simply do a simple kind of a diversification, your returns instead of 7.8% will jump to 10.5%. And the major number to look out here is your volatility is coming down by half. From 22.8%, it is coming to only 11.9%. Yeah. And your drawdowns are getting reduced by from 60% to almost 34%. So both the numbers are coming down drastically. So many people ask me, oh, what is the importance of drawdown? So let's take an example again of March 2020. Okay. So suppose you had invested in January 2020, say 100 rupees. Yeah. And by end of March, your 100 rupees would have become, says for example, the markets fell down 40%, your 100 rupees would have become 60 rupees. Yeah. Now, if you would have diversified your portfolio, so instead of 100 falling down by 60 rupees, it would have fallen down only to 80 rupees. Now, when market bounces back, yeah, so your 60 might become maybe 80, but your 80 will become 105, 110 kind of a thing. Yeah. So that is what the lower your drawdowns, the better can your returns be. So that is what we want to prove, that diversification helps and everyone should diversify their portfolio kind of a thing. Yeah. But of course, a simple multi-asset strategy not only improves your return, it also reduces volatility. The strategy over medium term keeps pace with Nifty even in bull markets, so one does not lose out on equity upside. So what happens when market moves? Yeah. So suppose if we get a period like maybe 2013, 14, 15, wherein in all 3 years market moved up. But because you have substantial, almost close around 50% invested into Nifty as well, so your portfolio will also move up. But because your drawdowns earlier were slightly lower, yeah, in fact 50% lower, your portfolio would do much better kind of a thing. Yeah. So this is actually what we wanted to show. What is the impact of drawdown on your portfolios? Let's take an example of this. Yeah. So we have taken 3 periods wherein Indian markets have seen a lot of correction kind of thing. So first is of course 2008, which is very fresh in all of our minds still. Of course, it was a very big scare. The recent correction from January till March, and of course the 2010 kind of a correction. Yeah. So if you go to see, yeah, let me, yeah. So if you go to see in 2008, yeah, we had seen a drawdown of 60%. Okay. The drawdown days, yeah, were close to around 300 days. So we had almost 1 year kind of a drawdown days. Time for recovery. How much time we took for the portfolio to recover? So suppose that time, if I'm not mistaken, yeah, we are close to around 20,000 Sensex. We had fallen down to 8,500, and we took almost 740 days to recover back to that 20,000 kind of a thing. Okay, let's take an example of recent example of 20 January to March kind of a correction. So drawdown was 38%. Okay, we took, there were only 69. So this time around the correction was very swift, and of course still we have not recovered to those levels. Till now, Nifty has not recovered to 12,500 levels, and similarly in 2010 correction, we had seen similar kind of thing. So if you see, the time for recovery is close around 740 days, 700 days. So we are talking about 2 years for your portfolio to recover. This time around, the correction was swift, and of course the bounce back was also swift. Of course, we still not kind of looked at the same kind of recovery because Nifty has not gone back to 12,500 level. But yeah, and it's a very big part. If you had done a simple kind of a diversification in 2008 or 2020, how much time it would have taken for your portfolio to recover, and how much drawdown you would have looked at. Okay, so if you see, instead of 60% drawdown, your portfolio would have been down only by 34% out here. Yeah, so less than, more than 50% kind of your portfolio would have got saved kind of a thing. Yeah. The recovery days, you look, see here, it takes around 740 days to recover your portfolio. Here it takes only around 300 days. Yeah. So again, this would have taken 2 years to recover your portfolio. This would have taken only less than one year to recover your portfolio. Similarly, in 2020, of course, if you would have under multi-asset strategy, your portfolio would have already recovered. And again, the main crux is because your drawdowns, your loss was lesser. So let me put it this way, your loss was lesser. So when your 100 rupees becomes, when you see a 60% correction, your 100 rupees becomes 40 rupees. But here your 100 rupees becomes only 65 rupees. Yeah. So whenever market bounces back from 65 to reach 100, it is much more quicker rather than from 40 rupees to 100 rupees. So that is what I wanted to say. Yeah. So a simple diversification not only reduces your drawdown, but also ensures that portfolio recovers faster. Yeah. So that is actually uh, when we are punching in the data, we are looking at the data. It was such a big no-brainer for all of me kind of thing, that why multi-asset, or maybe why not people focus so much on diversification, why people keep on running behind returns. So this is what the idea is kind of thing. Yeah. So also now let's look at what is the source of the drawdown, what is the main reason of this drawdown. Yeah. All of us are very kind of confident about Indian equity markets, but that is also the major reason for the drawdown. So if you go to see in 2008, yeah, out of the 34% drawdown that multi-asset saw. Yeah. So if I go to the previous slide, so I'm talking about referring to this particular number. Multi-asset strategy saw 34% drawdown, and in 2020, multi-asset strategy saw 22% kind of a drawdown. So what is the reason for that drawdown? So in 2008, out of this 34%, Nifty alone contributed to 60% of this drawdown. Okay, gold in fact was plus 1%, S&P 500 contributed close to around 20%, and fixed income was plus 6%. Yeah, so you see 60% because of Indian equities. Again in January to March, out of the 22% drawdown, 37% was just because of Nifty 50 kind of thing. Of course, this time around S&P 500 also saw a very big correction, but again the major contribution was because of Indian equities. So what is important? Yeah, the important parameter is controlling equity volatility, and equity drawdown is the key, yeah, of controlling your portfolio volatility, drawdown, and volatility. Yeah. So it is not only important to diversify, but it is also important to get down your drawdowns and volatility further down. And now how do you do it? Yeah. So that is where our strategy comes into play. Yeah. So Phillip multi-asset portfolio. Yeah. So what we do, we diversify the portfolio across, basically across four asset classes. One is Indian equities, second is gold, third is international equities, and the fourth is fixed income. Yeah. So how do we do it? Yeah. Let me take you to the next slide. So this is the strategy details. This is the under the investment approach. This is what we do. So there's always a static allocation to Indian equities at 10%, to international equities at 10%, to gold at 20%, and to fixed income at 20%. Yeah. So 60% of our portfolio is kind of a static. Yeah. When I say static, there won't be much change in this portfolio. There can be a slight change here or there, but there won't be much of a change. The remaining 40%, that is for Indian equities, that we manage dynamically. Yeah. How do we manage dynamically? So we have developed our in-house algorithms, which tells us when is the time to fully get invested into Indian equity markets, and also when to exit kind of thing. Because we have seen the Indian equity market is the biggest reason of the drawdown. Yeah. So how do we manage that? We'll have to do kind of in and out of the Indian equity markets. Yeah. And that is what the entire thing. So of course, simple diversification helps, but when you manage your volatility as well. Yeah. So we have, of course, these are just back tested results. Please, these are not any assured returns or indication of future returns or anything. But if you go to see, these are the returns that would have been possible over last 13 years. Yeah. So if Nifty 50, if you would have invested, if you remember the first slide, your returns were only 7.5% kind of CAGR returns. But when you do simple diversification, your returns were close to around 10%, but you manage the volatility of Indian equity markets, your CAGR returns can move up to 12%. And whenever people might say, oh, 2% higher CAGR returns, but 2% higher CAGR returns over 13 years is a huge number. Yeah. So all of us know that. So now let's look at the impact of the drawdown. So what we have compared here with Nifty, yeah, simple multi-asset portfolio, and Phillip multi-asset strategy. What is the difference? How soon we would have recovered the portfolio? How soon? What was the kind of drawdown we would have seen and everything? Yeah. So again, we have discussed this slide in the initial part of it. We have just added one more table on to this slide. So let's look at this thing. Yeah. So in 2008, under Phillip multi-asset strategy, your drawdown would have been only 13.5% instead of 60%. Yeah. recently from January to March, your drawdown would have been only 9.5% compared to 38% out here. Of course, simple diversification would have helped, but you see again from simple diversification, again your drawdown and volatility is getting down by another 50%. Yeah, and you see the recovery days. Yeah, so your portfolios would have recovered much faster, kind of thing. So this is what we wanted to showcase, that this is the crux of it. Yeah, so this is what we try to do. So it is not only simple of course diversification helps. Yeah, but when you manage the losses, or if you try to trade is not the right word, but if you try to slightly time your entry and exit of Indian equity markets, your returns can be much better, kind of thing. Yeah. So why Phillip multi-asset PMS? Of course, it's a diversified multi-asset portfolio that gives investor protection during economic distress, significantly limits drawdown. Yeah, it has got a very low correlation, and the portfolio volatility is manageable. Dynamic equity allocation. Yeah, so it is actually a perfect kind of a fit for people actually who have always been investing into fixed deposits, but now with lower interest rates, they're skeptical about it. But they are, when they look at equity market returns, it gives them a kind of a discomfort. So this particular strategy is an ideal fit for those kind of customers, and of course this strategy is a fit for everyone, but especially it perfectly fits for investors of those kind of things. Yeah. So these are the fund details. Of course, these are the kind of things that we need to take each of the investors through every time. Yeah. So this is the investment objective. Yeah. We exactly measure ourselves to what we are benchmarking ourselves to what we are doing as well. Yeah. So the Nifty 50 is the allocation is 40% the benchmark. Yeah. 20% to gold, domestic gold prices. Yeah. 10% to MSCI World Index, kind of thing. Yeah. So this is the strategy in crux. Actually, I wanted to finish the presentation in 20 to 25 minutes, so we can have more kind of a time for Q&A session, because as such it's a very simple kind of a thing. Yeah, that 50% of the portfolio is static in nature. Yeah, that 50%, 20% goes to gold, 10% goes to international equity, 20% goes to fixed income. The remaining 50% of the portfolio, yeah, is where we manage the entry and exit, kind of thing. So just to give you another example, yeah, let's take an recent example of January to March kind of a thing. Yeah. So when did our strategy give us a sell signal? So to be very precise, it gave us a complete exit signal in February 20. Yeah, February 2020. Yeah, so that is the time when it gave us a sell signal. And in second week of April, it gave us a buy signal. So what did we do on February 20? We completely exited the Indian equity portion and we invested into liquid funds. Yeah, and around second week of April, since it gave us a buy signal, we sold off the liquidities and we invested into again into the Indian equity. Now the instruments that we use are all ETF. Yeah, we don't take exposure to any individual stocks. As of now, that is what the design of the portfolio is. So we invest into Nifty 50 ETF, we invest into Nifty Next ETF, we invest into Gold ETF, we invest into Bharat Bond ETF, and we invest into S&P 500 ETF. So the cost structure is also low. And again, we are not trying to kind of play on individual names. Maybe we don't want to play on a banking or something. So that is why we are taking an ETF as a base kind of thing. So it helps us to, of course, liquidity is also much better, and it also helps us to not take individual calls on individual stocks and sectors kind of thing. So this is what the strategy is in detail. Yeah. So of course, I would strongly advise everyone to read the disclaimer in detail. Yeah. Please, there are no assured returns, no guaranteed returns, no assured capital kind of thing. Yeah. What equity has its own risk. You need to kind of take advice from your individual advisors or CAs and everything for taxation and everything. Yeah. And of course, if you need to get in touch with us, these are our contact details. So yeah. So now we'll open the floor for questions. Actually, we have got few questions of people who have already written us questions. So let's take that those questions kind of a thing.
Nishit, Nishit, sorry to interrupt.
Yeah.
So first, thanks for taking your time and highlighting why multi-asset is must for an investor.
Yeah.
And second, you have covered in detail how multi-asset reduce investors' portfolio volatility and drawdown without compromising the return.
Sure.
So great. And as spoke with you earlier, we have collected the questions and forwarded to you. Hope you'll be addressing this question initially.
Sure.
And then we'll move on to forum if time permits. I believe that we have next 25 minutes time.
Sure.
Given day. So
sure. Yeah. So we can take a lot many questions, and that is what the idea is. So actually, the strategy is not very complex. It is just the main. Yeah. So let's take the questions. Yeah. So the first question is okay. Okay. The first question is, what is the approx returns that we can assume? So actually, again, so there can't be any assured returns or guaranteed returns, but we have seen that this is what is possible. The entire idea behind offering this multi-asset strategy, and we have been working on this strategy for last one and a half year kind of thing, is because when we saw that many a times we get a lot of heart ache, or maybe we feel that why I did not sell maybe in January 20, or they did not book profits or something. So this is a perfect answer. If you see the correlation, this is actually, if you guys if you see whenever Nifty has been negative for a 12-month period, you see the other asset classes. So that is the idea. So of course I can't give a ballpark number or anything, but we are very sure, and especially where the markets are currently, we are very sure that this particular strategy would do very well over next 3 to 5 year kind of an horizon. So the next question is okay. So So the next question is, what are the instruments that you would be investing in? Would you be investing into stocks like Reliance Industries or HDFC Bank? So so of course I've covered it in the presentation. So we won't be investing into any particular individual stocks as of now. Of course, we have the strategy allows us to do that, but the right now the design is the strategy is being designed in such a way that we invest only into an ETF product. Okay. Either an ETF product or maybe a units of mutual fund. That is how the entire strategy is being. So we don't want to take individual calls on particular stocks on the sectors. So all the investments as of now, as I told you, so we invest into a gold ETF, Bharat Bond ETF, S&P 500 ETF, Nifty 50 ETF. So 30% of the allocation is to the Nifty 50 ETF, and 20% is to Nifty Next 50 ETF. Okay. And we have launched this strategy since last 1.5 months. So when we launched this strategy, we are fully invested. But recently, the strategy gave us a sell signal to come out of the Nifty Next 50 ETF. So we had recently sold the Nifty Next 50 ETF. The Nifty Next 50 ETF is basically, it gives us a flavor of the mid cap indices. So that is what so we had sold it off. So currently we are sitting on 20% cash as we speak on today. So so we have got one question who's asking us about the fee structure. Of course, for fee structure, guys, I won't be able to tell you on the kind of thing because I am the fund manager. So maybe we can talk about the fee structure. You can write to us, or maybe call Ankush or Sagar to know about the exact details. Please drop in us an email at pms@phillipcapital.in or talk to Ankush and Sagar. Of course, right now all of us are working from home, so I can't provide you the landline numbers. But Ankush and Sagar, they are part of the fund management team. It is not that. And see, PhillipCapital as such, this is the first time we are coming onto a platform like this. We had launched our PMS in 2016. All our strategies have been doing quite well. The performance has been great. So for us, it has always been taking customers' interest first. So we wanted to be one-on-one kind of thing. So of course, PMS Bazaar provided us this opportunity, and we have been able to connect with so many kind of participants. They told us that this is they got one of the highest registration for this particular seminar, and I see many people are again kind of joined this for this seminar. So for fee structure, please do write to us, or maybe call Ankush and Sagar.
Nishit, I also recommend the participant, in case if there is more questions on the fee structure, in addition to whatever names you have mentioned, And feel free to write to info@pmsbazaar.com. We will
Perfect.
address that
Sure.
questions after. You
Okay.
may
So
go ahead.
yeah. Okay. Okay. So now let's take I again see a lot many questions on the board as well. Yeah. So for the first question is, how do you manage downside risk volatility? Are you allowed to go long short? Okay. So firstly, we don't use any kind of derivatives or futures or options. Yeah. The idea is to use cash. Yeah. So whenever we feel that we are uncomfortable, we sell it off. Yeah. The sell off the Indian equity portion and we sit on cash. Yes. When I say sit on cash, that cash gets deployed into liquid fund. So we don't use any kind of derivative kind of instrument. Okay. So that is how we try to do, because derivative has its own risk and everything, and as such, of course, SEBI does not permit a PMS provider to fully use the derivative potential, and as such, all our other strategies also are long only in nature. This is, of course, this strategy is long only in nature, but we are managing the volatility and drawdowns by coming in and out of the Indian equities kind of thing. So the second question is from Mr. Anand. He has spoken about do fixed income and Nifty inversely move. See, of course, fixed income instruments have got a kind of a steady state of returns. Yeah, so the returns are very linear in nature, kind of thing. Of course, in Nifty, the returns are not linear in nature. 1 year we can maybe see 20% downside. Second year it can be 10% upside. Third year it can be 30% upside as well. So of course, there's a very low correlation between fixed income and Nifty returns kind of thing. So one question is, why not use covered call? Again, we are not of the opinion that derivatives is like playing with fire, and we are not open to use derivatives. That is a completely different ball game, and it gets its own kind of risk, and we are not ready to take that kind of a risk, and that is why we don't use derivatives. For us, the strategy is very simple. Yeah, use that diversification as such helps you a lot. Yeah, but again, to kind of more simple, give kind of lesser volatility and better returns to the clients, we manage the volatility by using our own algorithms. These algorithms have been based on certain momentum parameters, certain technical parameters, and certain fundamental parameters as well. Yeah, so it is not based on only one parameter. Okay, ये P ratio इतना है तो चलो let's sell it off or let's buy it. It's based on, and there's a big back testing that we have done over last 1.5 years. Okay, so I did not get one of the question is entered in 2000 April negative 20%. I did not get this question. Yeah, so if you can again please frame your question, I will take it up that. Yeah. Yeah, so one of the question is that S&P and Nifty is correlated kind of thing. Yeah, see, of course, globally, especially since we have seen since 2008, the global markets are kind of more related kind of a thing. But again, if you look at this data, it is not that true as well. Yeah, so if you look at this data, yeah, so CAGR returns, there has been a huge difference of CAGR returns of close to around 2.5 to 3%. Yeah, so that there's, of course, it moves in tandem, but the velocity of movement is different kind of thing. And we have seen, especially over last 3 to 4 years, US markets have done quite well kind of thing. Okay. Okay, so one of the question is that in February 2020, you got a sell signal. Can you show in your simulation data to go back to your claims? So see, of course, the proof of the pudding lies in this particular slide. Yeah. So which exactly tells us that, yeah. So this is, yeah. So you look at the extent of drawdown. Our strategy was down only 9.5% kind of thing in this particular period, against 38% negative returns for Nifty in that particular period. Yeah, so that this is what. So because the major fall came in actually in March, if I'm not mistaken, from second week of March till 28th March, that is where the major fall came in. The fall was quite huge, and it was I've been in this market for last 15 years. I've seen a lot of corrections, but this time around the correction was very swift and all those things. Yeah. So one of the question is, if ETF is used to invest in PMS, then how the static investments are controlled? Again, I did not get this question, but okay. So as I told you, 50% of the portfolio is into kind of static kind of an allocation. Yeah. So gold, international equity, and Bharat bonds is a kind of. So as of now, we are using Bharat bonds because that is in form of an ETF. Going forward, we might change that instrument, which might other instrument which might give us a better return or something. But this 50% is static. The rest 50% again is in an ETF form, but we manage. So what actually I like to put this strategy in this perfectly kind of a sentence, that it's a passive strategy, but it has got active ingredients. Yeah. So that is what I would like to put it. Yeah. So again, someone has asked me about the fee structure. For fee structure, either please get in touch with PhillipCapital or PMS Bazaar, and we'll be able to tell you. Yeah. Again, the fee structure, just to give you a flavor, there's of course a slight management fee that we'll be charging, but the main focus is on performance fees. Yeah. So that is what. But you will get an exact flavor once you write to us. Yeah, so someone has asked us international equity, what will be the portfolio? So Mr. Gupta, we use S&P 500 ETF as of now. So that is the that is what we would be using for investments right now. So going forward, we might look at Hang Seng or a Nasdaq ETF, but as of now, we feel S&P 500 because the volatility and drawdowns are there much lesser than what an Hang Seng or a Nasdaq offers. And of course, going forward, if we get much more options, then we might use that. So in your drawdown slide, why are the start dates and the end dates different for your Nifty and multi-asset strategy? Okay, maybe that's an error from our side, but maybe instead, yeah. So maybe that's an error from our side. Thank you for pointing out. We'll check on this. But again, it does not make much of a difference because in January, in fact, markets were up kind of thing. The major fall that we had seen was in March kind of a thing. And that is what we have taken that into consideration. Okay, sir, you will miss alpha multi-baggers if all money goes to index. See, of course, since I manage the other portfolios as well, Philip Signature India portfolio and Philip Emerging India portfolios. So that, of course, that also have done much better kind of thing because those returns have been much better than the index kind of thing. And we have been able to identify many multi-baggers, but also at the same time, and see in PhillipCapital is one of the biggest things that we also do. I, as a fund manager, keep on talking to many clients on a regular basis. Yeah. So it's not that unlike most of the other PMS providers, there's a constant connect with the fund manager. So when I talk to clients, many of the clients, let me put it, they also have this other Nishit, I'm not being able to take this volatility. They keep on getting worried a lot and all those things. So this particular strategy is mainly focus, multi-asset strategies mainly focus for investors like that. Yeah. Of course, everyone should diversify. I am saying that if out of your 100 rupees, some portion should be towards multi-asset strategy, some should be towards pure long-term portfolios, of course, and rest all you can take it. But since I manage the other portfolios as well, that I also sometimes feel, oh, I should have been in much better. This strategy would do much better. But overall, I would say that you should not put all your eggs in one particular basket, and that is where this multi-asset strategy is ideally suited for people who feel a lot bad. Oh, returns have gone down, drawdowns are too much in equities, I can't take it, kind of thing. So that, yeah. So someone has asked, can we keep a stop loss if we are down by 10%? We want to. So of course, there is no lock-in in any of our strategies, investment approach. You can come in anytime, you can go in out anytime. Yeah, but generally we always ask our investors to please give us 3 years kind of an investment horizon. We would want at least 3 years. Yeah, but of course, there's no lock-in. You can come in or you can go out anytime. So someone has asked us, what is your allocation to large, mid and small cap portfolio in your India equity portfolio? So I will take that question at the last. Yeah, first, this of course, this particular seminar today is only for multi-asset strategy, but I'll just touch base upon my other strategies, and maybe we can talk a little bit about the sectors that we are into kind of thing. Yeah. So once someone has asked us that in a downward market, this portfolio would do well. In a upward market, this portfolio might not do well. See, of course, if we get 4 to 5 years of constant 25-30% up move in the Nifty, then in that particular scenario, this portfolio might underperform. But we have seen that Nifty or any particular index does not move in one particular direction throughout all the years. So we get a lot of volatility. And of course, we have seen over last 13 years what kind of returns are Nifty been able to generate. So of course, that is a risk. Yes, if suppose from today, if you tell me next 5 years, Nifty is going to give you plus 20-25% returns on a constant basis, in that particular scenario, this particular strategy might underperform, but that is very unlikely. And that is where multi-asset strategy would do much better kind of a thing. So I've covered all the questions. Questions on the chat. Pallav, do we take any verbal questions before, if I wanted to just touch base upon our existing strategies as well?
No, you can go ahead, Nishit. I mean, you can pick questions from chat. There are a few questions which has been lined up in chat.
Okay.
Maybe I feel one question which is quite interesting. From there on, you can pick questions. See, somebody is asking like, what is the difference between multi-asset mutual fund and your product?
Okay, that's a great question. I of course, recently we have seen couple of mutual fund also launch a multi-asset strategy. See, of course, mutual fund are a great product, and I would strongly advise retail clients to go in for the mutual funds. But for an HNI client, a PMS makes much more sense, and especially a PhillipCapital multi-asset strategy. So we are not only, so what is happening, it is not a simple diversification. It is not simple diversification across 3 to 4 multi-assets. What I gather, I have not looked at those strategies in detail, but it is a simple diversification that what they are doing. Herein, of course, we are doing diversification, but to manage the volatility that an Indian equity gets, see the best of the stocks. In 2008, all of you would be surprised that even the best of the bluest of the blue chip stock like an HDFC Bank was down by 50%. So in that particular kind of a scenario, this particular strategy, our algorithms that we have built, which gives us a buy and a sell signal for Indian markets, I feel this would do much better. And of course, PMS, the minimum ticket size, since it's 50 lakhs for an HNI client, I strongly believe, of course, mutual funds are a great product, but for a HNI client, a PMS also makes much more sense.
Fine. So you will pick questions from this chat.
Do PhillipCapital trade in long short, maybe in another team? See, of course, under our PMS, we don't do any kind of long short. We have a normal broking, but that is, of course, it is more driven by the clients rather than by us kind of thing. So that is completely something different, which I am not an expert on it. And generally, I would strongly advise guys, please, whenever you firstly don't avoid doing trades on derivatives, and if you are doing derivatives, please be very disciplined, otherwise a lot of money can be lost. So the ideal situation for everyone, and this is my sincere request to all of you, whenever you invest into stocks, please invest into quality stocks only. Try to diversify your portfolio across 3 to 4 asset classes. This is my sincere request to all of you. Derivatives is something that I would not advise something like that. Pallav, are we missing any other question?
Could you touch base? Could you touch base on the taxation part? Many of them are interested in taxation side.
So see, another advantage, I'm not sure about how mutual funds are taxed, the multi-asset mutual funds, but someone on the chat only maybe, or someone was telling me yesterday that the multi-asset mutual funds are taxed at your debt taxation. So under this particular strategy, since the investments are in your name, there's a separate demat account. So 50% of your portfolio, which is gold ETF, fixed income product, which is Bharat bond currently, and your international equity, this would be taxed at your debt taxation kind of a thing. The remaining 50%, which gets invested into Nifty 50 and Nifty Next 50, yeah, there would be long-term and short-term taxation. Yeah, so I feel there's a slight advantage kind of a thing, because that taxation, if you are holding it for less than 3 years, I feel that's a disadvantage. But again, I am not an expert on taxation. You need to consult your tax expert and everything. But I feel that under this particular strategy, this might be an advantage.
Fine, Nishit.
Okay, when you switch between asset, which will be charged the performance fees? No, so the performance fees would be charged to you on an anniversary basis only. Yeah, so that is again, so at PhillipCapital, across all our strategies and investment approach, we charge performance fees on anniversary basis. We don't charge performance fees at the end of the financial year or end of the calendar year. So suppose if you join today on 25th September 2020, then you'd be, if your returns are above the hurdle rate, you would be charged performance fees on 19th of September 21. Yeah, so that is how we feel that is in favor of the clients. And of course, we follow the principle of higher watermark, which is a compulsion according to the SEBI rules and regulations. But we, across all our strategies, we charge performance fees at the anniversary basis. If you whatever AUM that we have gathered, yeah, 60% of the AUM is because of top-ups and references. Yeah, so till now, so now just to give you a flavor about all my other strategies, yeah, and let's the questions build up. Yeah, so we started, of course, PhillipCapital had a PMS license since a long time, but we started our PMS in 2016. We started with Phillip Signature India portfolio, which is a multi-cap portfolio. The entire idea was just to build a track record over next 4 to 5 years and then start approaching outside customers. The initial idea was just to capture the low hanging fruits that were available in the markets. And how we run our PMS is also actually completely different to how most of the other mutual funds, other PMS providers run. Yeah, of course, there are some very big, large PMS providers who have been doing quite a job. But what is our USP? So let me talk about our USP. So firstly, across my all other strategies, yeah, or investment approach, there's no single model portfolio that fits everyone. So we try to customize each of our clients' portfolio based on when they're entering, what is the valuation of the stocks that we want to buy, what is the valuation of the market that they are entering at. So it is not one client was entered 2 years back and a client was entering today. That portfolio has to be different, and we do that. Yeah. Some people say, oh, this will lead to a lot of job for you, but that is what we are getting paid for. Okay. The second thing, yeah, that how we differ, and this is a little bit maybe debatable. We don't invest our entire client's money across all other different. Of course, in multi-asset strategy, we have to invest on day one itself if the strategy says, algorithm says so. But across all our strategies, we don't invest everything on day one itself. The investment is made on staggered basis. Yeah, of course, if today Nifty was not 11,500 and if it was 8,000, then I would invest everything on day one itself. But otherwise, we take our time to construct a portfolio. The construction word itself means that it has to take time. Yeah. So if it was my money, would I invest the entire 1 crore on day one itself? No. So why should I do it for my clients? The third and the most important thing, and this has been the biggest learning for us, is after doing a lot of research, and trust me guys, we do a lot of research before invest into any of the stock, but there are chances that we'll go wrong, and we'll always go wrong, maybe 10%, 15%, 20% of the time. But the idea is to accept your mistake, sell off that stock, and then move to something else. So we have been disciplinedly following this. Of course, we constantly keep monitoring the performance of stocks on a quarterly basis, what are the results and everything is fundamentally driven. So whenever we feel we have gone wrong, so suppose recently we had Inox in our portfolio, Inox Leisure, which is a theater company. Yeah, of course, it's a great company, all fundamentals were in place. But after this pandemic came in, we thought that, oh, we made a mistake. This is not the stock to be in right now. Yeah, so we immediately sold off that stock. Of course, we sold off that stock at a loss. But today we are much more happier than what we would have if we had not sold off that stock. Okay. And the fourth and the most important thing which I've touched base upon is the access to the fund manager. Of course, there's always a relationship manager or maybe someone associated with you again, and all the we don't have a pure salesperson. All the guys who are there are part of the fund management team. They would be in touch with you. But apart from that, I as a fund manager talk to all my clients at least once in 3 months, 4 months kind of thing, or maybe they can call me anytime. If I'm free, I'll pick up the calls, or maybe I'll call them whenever I'm free. So that is how we have designed up entire structure, and all our strategies have been doing quite well. We have a Sharia compliant portfolio. Yeah, we have a PhillipStar portfolio which invests into mutual funds instead of stocks. So that is also something very unique. Of course, Phillip multi-asset portfolio is also very unique. So please do write to us and do call us, and we'll be more than happy to take your questions. Yeah. So now I see there are a couple of other questions that are lined up. Okay. Will your asset allocation on different asset classes remain same or change based on market condition? So yeah, it might change. Yeah, but as of now, we have taken a view that at least 50% of the allocation, which is towards gold internationally in equity and fixed income, that might be same, but this might change going ahead as well. Yeah. We have got how does Phillip multi-asset strategy different from multi-asset funds? So I already answered this question. Yeah. So I would not like to answer it again, kind of thing. Yeah. So that is it, guys. Yeah. So I guess I've answered all the questions, Pallav. Yeah.
Yes, Nishit.
Yeah.
Yes, wonderful. Nishit, what is the email ID you mentioned to connect with PhillipCapital if somebody is interested?
Yeah, sure. So this is the email ID one can get in touch on with us. Kush and Sagar, who are part of the fund management team. These are their mobile numbers. You can call them. Yeah, we would be more than happy to assist you.
Yes, in addition to that, you can also be in touch
of course.
with PMS Bazaar. We definitely handhold the investor.
Certain.
So, any closing note, Nishit?
No, guys, the only closing note I would like, please stay safe. Go out of your house only in case if it is very much essential. The virus is spreading. Yeah, all of us, I know all of us are kind of bored, or maybe we are kind of tired of this thing, but this is what and work from home. I'm hoping work from home is working from everyone. Of course, for many of you, this was for someone like my father who needs to attend his office because that is the nature of his work. But please wear a mask if you need to move out. Please take care of. Please do sanitize your hands and everything. And that is what I would like to leave everyone with. Yeah.
So kind of you, and I reiterate the same. So thank you very much, participants. I believe that this presentation would have been much useful. And again, I thank Nishit for addressing all the questions.
Yeah.
And
thanks.
Happy weekend.
Yeah, sure. Thanks a lot. Happy weekend, guys. Yeah. Please do take care of your health.
Thank you.